So this presentation that I've made is solely about entering trades. I made a presentation previously and that was on pretty much an A to Z, everything to do with trading. So the idea was you had no knowledge, no prior experience, and by the end you could place your own trades because you understand general concepts and general ideas about trading. What I want to do today is delve into actual entering trades, specifically what you need to look for, the analysis you need to do, and patterns that you need to spot to be able to place effective and essentially profitable trades in the market. This comes from a few different things. It's being able to spot when patterns are occurring, but it's being able to actually place the trades at the right time and not missing out stupid things like, for example, you don't obviously want to trade news. So I'll not waffle any longer. Let's just get straight into it. So why is this concept so important? I've pretty much just explained that, but what you want to do is enter the trades at exactly the right time and exactly the right place. For example, in this trade right here, if I'd entered, if I'd missed the entry point and I'd entered halfway through the TP, I'm going to win half as much. And if this trade did lose, my stop loss would be much larger. So then that risk reward's a little bit skewed. That's something that we'll cover a little bit later on. So this is basically what I base my full trade and strategies and trade ideas from, is the idea of stacking confluences. Now what this means is that you want to have as many things as possible telling you that a price is either bullish or bearish, and then that's when you can take your entry. So you've got inverted fair value gaps, liquidity sweeps, breaker blocks, in particular the unicorn model, and order blocks. The idea is you need to combine as many of these as you can in the market to give you a good idea of where and when to enter your trade and in which direction. So let's get straight into it. Fair value gaps is a concept that I've covered before, and it's a very, very simple and very, very common one. 3-candle formation in this area in the yellow here is liquidity. Now this means that price is very likely to either revisit the zone or when it comes back to this zone, react from it again. So what I've put here is an example of a break of structure and a fair value gap. So a break of structure is simply breaking an old high or low in the market. So we had our high here, our equal highs. And what's happened is prices broke through this equal high, so there's a break of structure, and also a fair value gap was formed from this level. But why is this important, and why does this mean that it's a high probability setup? So this fair value gap, we know that there's liquidity here, and we know that price might revisit it and it might react again. However, the equal highs mean that there's a level of resistance. Basically, price gets to this level, resists and comes back down, gets to this level, resists and comes back down. When it breaks through, comes back to this level, it does the opposite. So now it acts as a level of support. So now, not only is this a fair value gap telling us that the price might react, but there's also a break of structure. So now, and a level of support. So now we've got them things telling us that price is very, very likely to react. So I would be inclined to take an entry on this because I've been able to stack multiple confluences. Following on is the inverted fair value gap. So this is when price is a reversal in the market. So you've got the area in yellow again. That is a fair value gap, bullish this time. It's then disrespected. Now when we say disrespect, we mean the candle is closed below the fair value gap. This indicates a market reversal and that price is no longer bullish. So in this scenario, where you would want to enter from is where the candle closes. Very important to note, if the candle doesn't close below in the bullish example or above in the bearish example, and let's say it closes in the fair value gap or even just wicks up and wicks through, that's not classed as a disrespect and it wouldn't be an inverted fair value gap. We want to use this as a lower time frame confirmation as opposed to a higher time frame confirmation, but we'll come back to this later. It's very, very nice to use, as I've said here, when price collects liquidity from an old high or a low, and you can enter on a short in a bullish market, as we would think there's going to be a market reversal, or a long in a bearish market. So I've spoken about liquidity a few times, and it's actually a really common but a really simple concept once you understand it. So what you've got here is an old low. And as we can see here, price came down and then continued its bullish move. So what does this actually mean? So let's say we're in a buying market because the price is generally going up. So the chances are all of the buyers in this market are going to have the stop loss at this old low, because placing stop losses is about damage limitation. So you only want to put your stop loss at the point that would indicate that your analysis is wrong or the market is totally rejected in the way you think it's going to go. So you want to basically limit yourself from losing too much money. That's the whole point of a stop loss. So if price did go below this low and you were really, really sure it was bullish, you're going to get stopped out when it gets here. So then market, when it does come down, it basically collects all of the liquidity left from the traders that have been stopped out. So he uses that as momentum to then fuel the bullish move again. So we know that if we have a sweep of liquidity, and if you can see here, I'll try and zoom in, you can see here, bearish fair value gap, candle closes above that bearish fair value gap. That's an inverted fair value gap there. So you now then have a liquidity sweep and an inverted fair value gap to tell you that the market is bullish. So I would take a long here. Next up is the order block. So this is very, very simple concept as well. It's the last down close candle before a bullish move. So the down close candle and then a big, big bullish push. Oppositely, we've got a bearish move. The last up close candle, so the last blue candle, the last green candle, depending on the color of your charts, before a big bearish push. So the reason that this is important is this shows that buyers have seen prices at this level and class it as a discount. Best way to think of that, we trade gold a lot. So if you are going to buy a bar of gold, an ounce of gold, or whatever it is, you want to buy that at the lowest price possible, obviously. You don't want to overpay for what you're getting. So price has reached this level, and buyers in the market have thought, right, that's very cheap for this asset. I think I'm going to buy, which causes a big, big bullish push. So we can then use this again in the future. So let's say price comes back down and reaches this level again. What it means is that it's likely, buyers are likely to see this point in and go, right, yes, this price is a discount. We're going to go in the bullish direction. We're going to buy. You can use this in the bearish example as well for a premium. So if you're selling in the market and you see price reaches a high, you know you want to sell. For example, if you're buying Bitcoin, price has just hit $90,000 or $100,000 or whatever it was, you would think about selling then because it's at an all-time high and you're going to make the most money from that. That's exactly the same as Forex. It's the idea of sometimes price is a discount, sometimes price is a premium. So when price revisits these zones, price is quite likely to react in the same way. A breakup block is slightly different, and it's, as I've talked about before, a disrespect. So as you can see on the left-hand side here, we'll have a order block, and it's this area if we're moving across. But instead of reacting to the order block, price ignored it, and the candle has finished below the order block. So what does this mean? It means that price has basically ignored the order block and it's been disrespected. So it goes in the opposite way. This is now a breakup block because price has been broke and the structure has been broke. So then price then does revisit this. It does the opposite. It becomes a level of resistance in this case. So price revisits it, resistance instead of a level of support, which would act in this sense. So you might expect price to then react to this and come up in the bullish direction. Instead, total opposite. This is a really interesting example that I want to highlight for you. Reason being, some of the things that we've talked about before have come up again here. So this is a break of structure. You've broken the previous low. What do we also notice here? Fair value gap. Bearish fair value gap. So not only do I have a breakup block, not only do I have a break of structure, but we'll also have a fair value gap. So then when price comes back to this area, as it has done, we can put a very, 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 very high probability trade on, which is ideal because you're pretty much guaranteeing that you're going to win it. If you've got three things telling you that a price is, in this case, bearish, what's the probability that all three of your market analysis is going to be wrong or the market's going to ignore it? You're very, very likely to win that trade, so you walk away happy. Onto the unicorn model, which highlights both the fair value gap and the breakup block, which we spoke about previously. So I've simplified it here with just lines because this can be very messy and confusing to look at. So you've got the first break of structure. So we've broken that previous low. Important to note, the candle does not need to close below this previous low on the first break of structure. It can just wick down, it doesn't need to close. Then you go up, and you get a fair value gap that's been formed on this bullish move. But also, because the candle on the second break of structure has closed above this order block, it now becomes a breaker. So then this area is going to act as a level of support as opposed to a level of resistance if the price had reacted. So where these zones overlap is where we take our entry, and that's called the unicorn zone. Now this kind of just encaptures all of the things I previously spoke about: fair value gap, breaker block, order block, support, resistance, all comes into this model. So then if we look here, we've got a low, the candle's finished below the previous low, a high, so with two breakup structures. In this move, we'll have in the yellow, we've got the breaker block. In the green, what we'll have is the fair value gap. And what we'll have in the purple, that thin slither, is the unicorn zone. So that's where we're going to take our entry from. You notice that I didn't take an entry at this point, even though it's wicked back into that fair value gap. The reason I didn't take an entry here is because this break of structure, the candle hadn't closed above the previous high. So it hadn't formed a breaker block yet. I mean, in this example, it would have worked, but, you know, if it hadn't, that might be why. That's one of the most common reasons where people might not use the unicorn model correctly. So in this example, yep, price revisits the zone. That's where we take an entry from, and we hit with TP. So what I want to talk about now is something I mentioned previously, and it's lower time frame and higher time frame, and how we're going to use them both. Now, what I'm explaining here is essentially just top-down analysis, which I've probably mentioned before if you've been in the group. So higher time frames, when I talk about that, is daily, 4 hour, I've not got daily here, but daily, 4 hour, 1 hour, 15 minutes. I think the 15 minutes is somewhere in between. So you potentially could use that for lower time frame. So the high time frames, what you want to look for is order blocks, fair value gaps, and significant old highs and lows. And then on the lower time frame, you want to look for inverted fair value gaps, unicorn models, and liquidity sweeps on the 1 minute and 5 minute time frames. This is where I take all my trades, or pretty much all my trades, on these time frames, mainly the 5 minute. I feel like the 1 minute can move too fast sometimes. So the 5 minute is perfect for myself. So top-down analysis is essentially going with higher time frames, looking for everything I've just named. So you're marking out the order blocks, marking out the fair value gaps, and all highs and lows. That is just marking out liquidity in the market because they're all areas of liquidity. Then these are our confirmations. So when we're seeing an inverted fair value gap and we know that it came, in line with an order block, we can then take an entry from that because we're stacked confluences. We've got two indicators telling us that price is either bullish or bearish. So then you go on how you're going to actually combine these confluences that you're stacking. So for this example, we've got an order block and an inverted fair value gap. So in our higher time frames, in this case, the 4 hour, what we've identified is an order block. We've then waited for price to come into this 4 hour order block on the 5 minute time frame. On the 5 minute time frame, what's happened is we've had a big bullish move, a fair value gap, and also a big bearish candle, which means that it's an inverted fair value gap. So now, not only have we swept the liquidity that's been left at the order block, but we've also had an inverted fair value gap. So there's two things telling us that the market is now bearish. That is why we take our entry from here. One thing I'd like to highlight, and that's very, very important, is that you should only enter off an inverted fair value gap once the candle's closed. Because let's say it wicked back up and ended up closing within this fair value gap, that means that this fair value gap has not been disrespected and therefore is not a valid inverted fair value gap. So then we would not want to take an entry off of that because we'll only have one thing telling us that the market is bearish, and that being the order block. I'll come on to take profit and stop losses soon, but what I've done is put the take profit at the swing low, and I've put the stop loss at the top of that candle. Next example, what we'll have is a liquidity sweep plus a unicorn model. The unicorn model is what I basically enter most of my trades off because it works so often. What we'll have is a liquidity sweep. So there's an old low that I've drawn across the bottom, and price has wicked down and collected that liquidity and used it to fuel its bullish push. What's happened within this move is we've got an order block, we've also got a fair value gap, and we've also got two back-to-back break of structures. So this is the first break of structure down here. The second break of structure is this candle here, because it's broken that order block. And this zone is the unicorn zone, which I've spoken about. So in this example, what we've got is actually three things telling us, or three. So in this example, what we've got is three confluences that were stacked. So it's a very, very high probability setup. First of all, we've got a break of structure. So this, what would previously have been a level of resistance, is now a level of support. A fair value gap that's been formed on this level of, well, now support. And also, we can see down here, we've got an inverted fair value gap. So we know that along this level, down here, the green and the line, which is the break of structure, we know that there's a level of support here and prices are quite likely to react. But not only do we have that, what we've also got is an inverted fair value gap. So we've got, on this bearish move here, what we've also got is a fair value gap that's being disrespected. So what we do is take an entry from the top of the candle. And in this example, I've just put it at that swing high. However, when you've got three confluences stacked like this, there's quite a high probability that you're in a really, really bullish market like this. So you could have put the take profit a lot higher and had a higher RR trade. So probably one of the most important concepts within the flow of trading is actually where should you place your take profit? Because realistically, if you're not putting your take profit in the right place, you're going to fall short, or your RR is not going to be right, and you're not going to become a profitable trader or as profitable. So the most important thing to think about whenever you're placing your TP is that price is always moving towards some sort of liquidity. All the trades we've covered are liquidity sweeps of some sort. So order blocks, fair value gaps, old highs and lows, everything that we've spoke about, they're all areas of liquidity. That's why price always revisits them and heads back to them. So say in the example for the unicorn model and liquidity sweep, we want to put our take profit at the next area of liquidity or at a area of liquidity. So this the order block up here before the bearish move, that is where we've placed our TP. In this example, we've went from an internal range liquidity, fair value gap, to external range liquidity, order block. So on the other hand, where should you place your stop loss? So it's really important because the reason for a stop loss is actually just mitigating your loss. When you do lose, and it will happen as a trader, you want to make sure that you're basically losing as little as possible. So, I mean, it's a balance because you don't want to get stopped out too much because your stop losses are too tight, but you don't want to be taking huge losses. So what I do is I'll always place my stop loss at the point that would indicate a change of character or a total opposite in the market. So at this point, I know if I've entered here, if price came down and went below the previous low, and I'm pretty sure that I've got my analysis wrong or the market's just not reacted right, and it will happen. So I'm then happy to concede that, and I know I've lost that trade. Which leads us on nicely to the risk-reward ratio. So it's just how large your take profit is in relation to your stop loss, and it's really important. So, for example, this one is 2.59. Now, this means that, say I risk 1%, say I risk £1,000, I'm then gaining 2.59% if it hits TP. So I'm gaining, 2.59k if I had risked £1,000 on a trade. So what you can do is use a lot size calculator. That can tell you how much you want to risk, and it'll also help you manage if you're doing a funded account and all that sort of stuff. So I hope this has been very, very useful to you. I hope you can use this to enter trades. I hope you can use this to understand some of the concepts we spoke about a bit better. I want you guys to be able to enter trades off your own back, understand the market, and not rely on anyone. That's always the end goal. If you do have any questions, any queries, stuff you're not sure about, by all means drop us a message, and I'll be more than happy to get you sorted. Cheers, guys.